Chapter 20 is about partnerships, and here we're introducing the concept of flow-through entities. Basically, that means that the company itself, the partnership itself, is not taxed on its profits. Essentially, the partnership, you still have to prepare income statements and tax returns, calculating taxable income and all that stuff, but the taxable income isn't taxed on the partnership tax return. Instead, that profit flows through to the partners, and the partners are then taxed on the profits that flow to them, depending on what their ownership percentages are. Then, assuming there's, like, say, a bunch of different individual partners, each partner would have their own individual tax return prepared, and on that tax return, the profit from the partnership would show up. It would increase the partner's taxable income and the partner's tax. So that's what the concept of flow-through entity means, and you'll see how it works when you get into the tax return for this chapter. We're going to start by talking specifically about how partnerships are formed, and what happens, or how do you calculate a partner's interest or partner's tax basis in their interest in a partnership when they initially invest in a partnership. There's a couple different kinds of interests in a partnership. There's a capital interest and a profits interest. You can read about those here. A capital interest means you're buying in and you have the right to receive liquidation rights. If the partnership were ever liquidated, you'll get cash coming from the sale of all the assets. A profits interest is only the right to receive a percentage of the profits of the company. It's while it's in business. You don't have any rights to receive any liquidated assets if the company goes out of business. Some key facts about property contributions. Most importantly, partners typically don't recognize any gain or loss when they contribute property to a partnership. So if a partner has land, and it's worth $100,000, and their basis in the land is only $40,000, then when they contribute that land to a partnership, there's no gain recognized on that. Even though it's worth 100 and their basis is only 40, they are in a gain position, but it's not like a sale that would cause a gain recognition. These non-recognition rules are there because the government doesn't want to preclude people from getting into business and doing things like this that make business sense just because there might be a bad tax answer. So calculating the initial basis of a partner is also very important, and you can see the basic rule here. You start with the basis of the contributed property, so not the value, the basis of the contributed property. It's called carryover basis, and then you subtract any debt that's being relieved. So if that land in my example was mortgaged, then that mortgage would be being taken on by the partnership. So that's a relief of debt to the partner. So they have to reduce their basis for that relief of indebtedness. Then any partnership debt allocated to the partner would increase. That's if would increase the partner's basis. That's if the partnership has debt, and the partner is responsible for paying some of that debt. Then the partner will get to add that amount that they're responsible for to their basis. And then if there is any gain recognized in the unusual scenarios where gain could be recognized by a partner contributing assets to a partnership, then that would increase their basis. So here's the basis calculation rule right here for you to follow in problems where it comes up. And this is going to be a several part study objective or learning objective, so I will continue in the next one.